Well, it's starting to rain here a little bit, Florida. Interesting article from Silver Doctors. Read this last night, so yeah, I think it's time to do a video on this one. The markets edge closer to collapse. What about the derivatives? The pension funds are dead meat. They have no hedging alternatives. Their only hedge is if the Fed or government decides to shut down the markets in order to prevent selling. No sell orders. Once again, by a man who knows the markets well, Dave Kranzler, Investment Research Dynamics. The massive, unprecedented level of central bank intervention in the markets has terminated the purpose for having capital markets. Currently, the only goal of the Fed is to do what needs to be done in order to prevent the markets from collapsing. This has been the mission since 2008 and really since 1987. And I think he says that 1987 because after the 1987 market crash, we had what we like to call the plunge protection team implemented, which is really called the President's Working Group on Financial Matters. And they essentially rig the markets in order to prevent a meltdown or whatever. Unless it was 2008. Then they're allowed to let it happen so that they can pump fear into everybody so they can get these massive bailouts. Just another government agency doing what it does best, which is working for the bankers. The ongoing effort to push down the price of gold and silver is essentially to prevent a big move higher in the metals from signaling to the world that the global financial system is collapsing. If you don't want everyone rushing out of the coal mine, remove the canary before it dies. And now you know why they've been hammering silver and gold here, especially right after the Fed Janet Yellen speech. We're gonna raise rates, just like we thought. Gonna raise rates. Oh, gold and silver. The day it happened, they went up nicely, up, back down. Next day, oh, what's that? Whoa, what happened over there? You don't think they're expecting a big move up and they're preparing for it, do you? No. Imposing downward pressure on the metals using their derivatives form is the Fed's act of removing the canary from the coal mine before it dies, as he said. You know, that little analogy. At some point, the canary will escape and fly back into the coal mine. Zero Hedge published this graph earlier this morning, and it shows the extreme volatility of the S&P 500 right after New York Stock Exchange open. It's a 5-second graph of the March S&P 500 future. The obvious trade right now is to short the stock markets. This is probably the last alternative available for hedge funds to hedge out their illiquid fixed income positions, especially the junk rated stuff. The pension funds, as he said, are dead meat. They have no hedging alternatives. Their only hedge is if the Fed or government decides to shut down the markets in order to prevent selling. Kind of like what China did. Will halt, or not necessarily halt, but they said it'll become immediately illegal for any of you bigwigs to sell any stocks. You got to hold on to them. This is all the more reason why you should be having precious metals in your possession, because you can go anywhere at any time and sell them. The Fed's not going to come in, no market trades today, or that's happened. No. They don't even know you have it. They have no way of tracking it. It doesn't matter. The stock market, futures and options and trading every day, they know exactly what positions are out there, who has those positions, who's short, who's long. They know it all because you're playing in their system. And their system is telling them what positions are there. You may have an order, put a stop in place, whatever, it's fine, but they know we have X amount of contracts out here right now these many short, these many long. They can do whatever they want. They can crush the market, they can let it go up, they can do whatever they want. I suggested several months ago that this was coming eventually. The gating of junk bond funds is the start of this process. Gating is the same thing as shutting down a market, as it prevents anyone from selling their positions. Please notice that discussions about the OTC, or over-the-counter, derivatives seem to have slipped out of the public forum. For the most part, this simply means the problem has gone away. But OTC derivatives lie at the heart of the problem for the Fed. Fuses have been lit and are moving closer to the detonators, if you will. No one knows when the big explosions will become uncontainable, but that really grows closer by the day. I don't know what meaningless policy decision will be regurgitated by the FOMC on Wednesday, which is what we just saw, which was, again, the rates going up. I'm sure a lot of midnight oil was burned over the weekend working on the draft, but the stock market has at least 1,000 points of downside risk and little to no upside, unless the Fed goes Weimar with the printing press. So, a couple of comments. The pension funds are dead meat. They have no hedging alternatives. Considering all the trouble that the hedge funds have gotten themselves into recently, perhaps the pension funds not having a hedge is a good thing. They might very well be dead meat, but for other reasons. Not for their lack of a dubious investing technique, but then pension fund managers are aware of this and are more careful with the money they oversee than others might be. When a fund does well, so do the managers. When a fund does poorly, again, so do the managers. Yes, there are exceptions to this, but this is the general rule. Fund managers do not like it when large numbers of their clients jump ship and head for better performing or lower cost funds. While individuals can't do this with their pension funds, in most cases their employers can and will if necessary. Before I retired, the company management where I worked changed pension funds 4 times over 23 years, or over the 23 years I had my 401k. Sometimes this was over disagreements in fees, and sometimes it was due to mediocre performance. Well, your fund, the people controlling your fund, I hate to say this, I don't think they really care as much as you think. And yeah, your company probably did most of its changing because of the fee issue. Why are we paying these fees so much of a fee? Not because of underperforming. You might, or maybe I should say we all might like to think that whatever company we work for that has a 401k or whatever it is, where they're monitoring the markets and these different investments, and they'll move it when they need to. But you take, for example, a company like Fidelity, and you'll find, oh, that's who we use. Oh yeah, that's who we use too. A company like that, that's who a lot of American companies use to deal with their 401ks. So when you have that much of money belonging to people that is under your control, and you are getting all those little fees, that's a whole lot of money coming into you. And it doesn't matter whether the market or how the fund actually performs, because as long as that money's there and coming in every week or every month out of those paychecks, you're still getting your fee off the top. The market could crash the next day to something catastrophic, and that company didn't really lose anything. They've been taking and swiping their little fees off the top the whole time. Sure, they don't want to lose. They don't want to say, hey, go somewhere else. You know, we weren't paying attention. Now you're going to go somewhere else, because now we lose those fees. So yeah, they do have an interest in that. But I don't think that there's people out there who are continuously looking to move all this enormous amounts of money because of underperformance or whatever. You know darn well that, like everything else out there in this world, someone's getting paid off, someone's getting a little nugget over here. Hey, send that fund money to our thing, you know. It'll perform decent, boy, but it may not perform quite as good as this one over here, but I know that guy, and we're, you know, and when I leave this company, I want to go work for him. Matter of fact, he's promised me as long as I did this for a year or two, put the funds in his investment, I'd have a real nice cushy job. So I'm going to do that. Are you going to know that when your company is that client of, for example, Fidelity? And I'm not saying Fidelity does this, but that's just a big name. So is your, you got Fidelity handling your 401k through your company, so that their next down from there is your company. Then your company's HR department, really, who made that decision, and then you. And like most people, I don't think anybody's really watching too much with their 401k, how it's performing. Yeah, you get your little end of the year, your little statements or whatever, and you're looking at it, where am I at? And all you can do, if you want to change, it's not up to par. Yeah, I think I want to change. Well, hold on, I thought they're watching your investment for you. Like, I thought, why do you have to call? Hey, I don't like the way it's performing. What else can I put this in? I saw this other thing, And it's like politics. You can only choose from two, right? You got a Democrat and a Republican. Pick. Yeah, but they're both part of the same club. But you have a choice, and in this country you have a choice. One's a Democrat, one's a Republican. You got a choice. Pick one. Wow, what the hell kind of choice is that? There's only two. There's 300-something million Americans. I only have a choice of two? Yeah, pretty much. And that's the same way you look at this little sheet, and you got the low, safe investments. You got the mid-range, a little bit risky, decent return, and then you got the high yield, potentially risky, but pays off quite well over time. And as these so-called experts will always tell you, well, you're young, so you can afford some big ups and downs even, going with the riskier stuff. But over the span of what you anticipate working the next 30 years or whatever, I mean, if you just look at this chart over here, it'll show you that you would have done extremely well. So you see that and say, oh, well, okay, that sounds good. And then when it's time for you to retire, it's in that little down part of the chart you're looking at when it did this. And now you need the money the most, so you're ready to get it, and it's in this mode. And you're saying, man, there goes 30 years. What it would have been if I was in that lower or mid, oh, man. Because it's down where it's at right now, I'd have been better off with the other ones. But even then, the point of the whole Democrat-Republican thing, here's, again, example is Fidelity. Here's a list of investments you can make. Just a little small list of where you want to put your money. That's it. Of all the things in the world, this is all I've got. This little so-called choice. And you have them already separated for me. Low risk, medium risk, and high risk. You guys got any gold stuff in here? Oh, no. Sorry about that. No gold stuff, huh? No. Just paper stocks. So, junk bonds are in trouble. People's 401ks are in trouble. Pension systems absolutely in trouble. Not looking good. And when you see the Fed make their decision, oh, we're raising rates, and then gold jumps, silver jumps, and then up, smash the next day. And it's being smashed just recently, right? But both of them have been hit hard, even before the decision from the Fed. So both before the decision, they're smashing it. After the decision, they're smashing it. Why would they be so ruthless right now? Again, it can only mean one thing, in my humble opinion. They know the rates, the price of gold and silver are about to rise. And maybe even, as the webbot is saying, rise substantially. So as he was just saying, the canary in the coal mine is gold and silver. But if they take the canary out as you walk into the coal mine, hey, where's that thing at? That little thermometer, so to speak. Because if that thing dies, I know we need to get out of this mine. That's the canary in the coal mine. The canary is brought into the coal mine in the old days because the gas that can kill a human, you can't smell it, can't taste it, you don't know it's there, but it will kill the canary way before it kills a human. So you're walking around with this canary, the canary just keeled over. Guys, it's time to get the hell out of here immediately. That's the thermostat, so to speak, or the temperature gauge, so to speak. Is there poisonous gas in here? Here's a thermometer. Oh, the thermometer just passed out and died. Yeah, time to go. So in the financial world, I got gold and silver in my hand. Here's the thermometer. Here's the temperature. It's supposed to be rising. What the hell's... Actually, I feel some resist. I can't even force it. What the hell? Let me look behind this little curtain here. Oh my God, they're rigging the markets. Holy crap, right? They're rigging the price of gold and silver. No wonder it can't right? But you have to be intelligent enough and, most importantly, informed enough to figure out what's going on. So if you know someone is purposely killing your canary, not even necessarily killing it, giving you a fake one that's robotic, therefore it can't die when it smells the gas. But it's a real good job. I mean, this thing looks real. You whistle at it, it whistles back. You know, whoa! I got me a nice little canary. I'm taking this sucker in the gold mine with me. It's walking around its little cage and pecking and right. It's a happy little canary. And then it should die. Gas is coming. You can't smell it. You don't know it. And you see, hey, old John over there, man, he's having problems breathing. What's going on? Management comes in, nothing's wrong. He's fine. He just had a little problem. We're going to take him out, get him checked out. Don't worry about it. Don't talk to anybody else about this. Oh. Alright. Let me check my canary. Man, canary's looking great. Okay. Oh, shoot. Someone else just passed out. What the hell? Well, let me look at the canary. Canary? Oh, it's fine. And it starts messing with you because I've got this tool that's telling me whether things are good or bad in this mine right now. Either we're going to die or we're not, and it hasn't said a pee, or hadn't, of course it's not going to pee, it hasn't died, it's walking around still. And then one day you just get the idea, right? There's other things here that tell me this thing should be dying, and it's not. So why isn't this thing done? Let me examine this thing a little more closely. You start peeking around at it, oh my God, it's robotic. Somebody tricked me. Oh my God, that means I'm in danger. I'm out. Right? You just made an informed decision, because prior to you checking out that bird, realizing it's fake, you were not informed. You were uninformed. Doesn't mean you're stupid. Doesn't mean you're uneducated. You were simply uninformed. But now that you're informed, you're not only informed, you're freaking pissed off. Who gave me this fake bird? Because now I know why you gave me the fake bird. You needed us to go back in there and get work done for you in extremely deadly conditions. Okay, so who's the bright guy that put this fake bird in here with us? Oh, well, it wasn't me. Well, we don't know, but we got it from China, right? That's what they're doing with gold and silver through the COMEX market with their paper derivatives contracts, essentially, that they're trading every day. There's no position limits. They can hold as many of these contracts as they want, which is why you've seen 300 and something to 1 ratio of paper gold to real gold. Recently, very recently, we've never seen numbers like that before. There has to be something coming down the line soon, in my opinion. It's got to be. In which they know is coming, the club, and is why they're attacking gold and silver in advance so that it's as low as they can get it when the price starts to pop back. And it's going to pop back heavily, which again is why they had those rules changed in November of last year by putting circuit breakers in for gold and silver. If they rise too much or fall, but we're talking rising here, trust me. They rise too much in a certain window of time, circuit breakers, all trading is halted. Circuit breaker time limit, okay, and you're back trading again. Go again. If they do it again, period of time, boom, second circuit breaker triggers. 4 times in a day, supposedly, is the amount of circuit breakers that can trigger, which essentially is a top of $400 total for gold that it could move, or $12 for silver in a day. And I'm going to end this video by reminding you, WebBot long ago said you would be seeing $5 per day moves. This was before that decision was made by the CME group last year, by the way. $5 a day moves coming in silver, to be followed, not sure how or soon, when, whatever, by $20 moves in a day. Now you know why They've been relentless on gold and silver by pushing the price down, trying to kill off that thermometer, so to speak. That is why. Now it's only a question of when is this reversal going to happen. Bitcoin is safely in the 450 range right now. It went through 408, like the webbot said, 428, and should remain above that price, not bounce back down like it did last time. That should be the key sign that silver is about to make a big move. And by God, it's happened. As you've been following, it has happened. Bitcoin is above that mark. So, again, all we can do is sit back, watch these little cockroaches scramble, watch them attack precious metals and whatever else they'd like to do to try to trick everybody into thinking everything's fine, don't worry about it, when it's not fine and they know a big rise in the price is coming. Take care.